What situations impact RMD penalty assessment? Imagine this. You've worked hard all your life to save for retirement, and now it's time to start taking your required minimum distributions. But what happens if you miss a deadline or don't withdraw enough? That's where understanding the situations that impact the penalty assessment becomes really important. The main thing that triggers a penalty is failing to take the full required minimum distribution by the IRS deadline. For most retirement accounts like traditional individual retirement accounts, simplified employee pension IRAs, savings incentive match plan for employees IRAs, and employer-sponsored plans such as 401ks, you need to start taking RMDs at age 73. If you were born in 1960 or later, the age is 75. The first RMD must be taken by April 1st of the year after you turn the required age. After that, all subsequent RMDs are due by December 31st each year. Missing these deadlines or withdrawing less than the required amount can lead to penalties. The penalty for not taking the full RMD or missing the deadline is 25% of the amount that should have been withdrawn. This is an excise tax, and it's been reduced from 50% in recent years to make it less harsh. For example, if your RMD was for $1,000 and you missed it, the penalty would be $1,000. However, there are some situations that can affect how the penalty is assessed. If you correct the missed RMD within 2 years of the deadline, the IRS might lower the penalty to 10%. To do this, you need to file IRS Form 5329 with your tax return and show that the shortfall was due to a reasonable error. You also need to demonstrate that you are taking steps to fix the mistake quickly. If the missed RMD was caused by a reasonable cause, like a serious illness or an administrative mistake, the IRS may waive the penalty. To do this, you must file the correct forms and explain the situation. It's important to act fast and communicate with the IRS to avoid or reduce penalties. Having multiple accounts adds another layer. You need to calculate the RMD for each account separately but can withdraw the total required amount from one or more accounts combined. If you fail to meet the total RMD from all accounts, penalties can still apply. Roth individual retirement accounts usually don't requiring RMDs during the owner's lifetime, so penalties are not a concern there. Starting in 2024, Roth 401ks are also exempt from RMDs, which reduces the risk of penalties for those accounts. Employer-sponsored plans like 401ks generally requiring RMDs to start at age 73 or when you retire if that's later, unless you are a 5% owner of the business. Missing RMDs from these plans can also lead to penalties similar to those for IRAs. Finally, when you miss an RMD, you must file IRS Form 5329 to report and pay the excise tax. Not filing this form can make resolving the penalty more complicated and increase your tax liability. Understanding these situations helps you avoid costly penalties. Planning your withdrawals carefully, keeping track of deadlines, and working with financial or tax professionals can make sure you meet your RMD requirements on time. If a mistake happens, acting quickly and filing the right forms can help reduce or eliminate the penalty.